What is a debt fund in real estate investing? So you want to invest in real estate without owning property or managing tenants? That's where real estate debt funds come in. They offer steady income without the headaches of active management in real estate. So what is a real estate debt fund? A real estate debt fund is a pool of investor capital that's used to lend money to real estate borrowers. Instead of owning the property, you become the lender. Once the fund raises capital, it makes short or medium-term loans secured by real estate properties. You can earn income from the interest paid on those loans. So how does a debt fund work? Well, the debt fund collects money from investors, and then it lends it out to real estate operators or other real estate investors. The funds can be used for buying, building, or renovating property. In return, the fund earns interest and passes a portion of that to the passive investors that are in the fund. Most funds pay returns monthly or quarterly. What type of projects do debt funds finance? There's many projects. There's bridge loans for value-add properties, meaning they're typically 6 to 24 months. There are construction loans for new developments. There's cash out refis for stabilized commercial or residential properties, where investors want to pull money out of those assets to go reinvest. So what are some common asset types that debt funds like to lend to? Multifamily, self-storage, mobile home parks, industrial, retail, office. There's essentially many different debt funds that will lend on any type of residential or commercial property, including development projects. This is where right now in 2025, it's difficult to get a development loan, and many debt funds are now filling that gap, providing those loans for significant rehab or construction projects. So why do investors like debt funds? Well, they offer consistent income. Who doesn't like to be the bank, right? Typically, debt funds also charge higher interest, 8% to 12% or even more annually. And they generally are less risky than equity deals because the loan is backed by the real estate and the loans are lower leverage, traditionally under 65 or 75% loan to value. But some debt funds will lend up to 80 to 90% of the appraised value of the property, but that is rare and risky. Another benefit is you don't deal with the property management. As an investor, you don't have tenant issues or value-add execution. Investing in a debt fund is being a lender, so it's passive, predictable income. So what are the risks? Well, default risk is the number one risk. If the borrower can't repay the loan, you aren't getting paid as an investor. Market risk. If the property value falls and the collateral becomes less valuable, you could be upside down with the loan that you own on the asset. Liquidity risk. You may not be able to get your money back if the borrower doesn't pay you back in a timely manner. So you may have to wait before the borrower gets the funds in order to get your liquidity out of the fund. So when evaluating a sponsor or a debt fund's lending strategy, it's really important to underwrite the actual sponsor or the manager of the fund and their experience. It does matter. So when does a debt fund make sense for you? Well, if you want passive income without the work of owning a property and you're looking to diversify away from public markets or public securities like stocks and bonds, and you value capital preservation and lower volatility compared to traditional real estate equity investing or real estate acquisition and you being the key partner in a real estate transaction. And debt funds are great for self-directed IRAs or long-term capital that you don't need immediate access to. So be sure to give yourself at least 12 to 24 months of illiquidity earmarked funds towards this type of investment. Do not expect the money to come back quickly. Even if the debt fund is structured in 6 to 12-month increments, it could go longer, so don't count on that money coming back quickly. Final thoughts. Debt funds give you exposure to real estate with fewer moving parts. They're not flashy, but they're built for steady performance. If you want monthly cash flow and downside protection, debt funds are worth a closer look. So want to compare debt funds and see which ones fit your goals? If so, download my free guide, The Passive Investor's Guide to Real Estate Debt Funds. It walks you through return profiles, structures, risks, and how to vet operators in the debt fund world. And if you're curious about how to use a debt fund to invest with your self-directed IRA or Roth IRA funds, And check out my next video on building tax-free income streams with private debt. I'll see you there.